So we're going to talk about Buy Properly, the new fintech
Yeah.
today, and we're lucky to have Khushboo Jha with us, the CEO. And are you founder, co-founder? How does that work?
Yeah.
Let us know who you are. Welcome to FI Garage.
Thank you. Thank you for having me here. Yes, and I am the founder as well of BuyProperly.
That's awesome. We've we've talked about alternate investing on the show before, and we've talked about fractional real estate, and it really hasn't been available much in Canada, but Buy Properly is now available online. And
Yes.
just run through the basics of it for our listeners as a start off here so we can kind of get some grasp of what we're talking about on the show here.
Sure. I mean, for end customers, it's super simple. It's modeled on Amazon, so to say. So you go online to the platform, you browse through properties, you see what you like, you get to see all the details of it, similar to what you would see on Amazon. You click buy. You of course have to have your profile with us because this is financial services, so we have to do KYC, etc. And then that's it. You check out. You make the money transfer. You get the shares. I think the way it works is every property is structured like a company. So each property is a standalone company, and when you're buying a part of that house, you're effectively buying shares of that company. And that one single company, all it does is owns that house, rents it out, and makes money from that single house. So that's how it works in the background. Of course, as you can imagine, this is almost like an equity investment. So we have to do the KYC, AML, suitability, all of that in the background. And assuming for most Canadians it would work, but if at all there's somebody who's not qualified to invest, then the system would not let them invest.
Okay, I signed up when I first found the platform, and you were on Maple Money before. I heard that podcast,
Yes.
but I'd actually found you a little bit before that. So when you came on
Okay.
Tom's show, I was like, oh, that's interesting. I can't wait to listen to that. So glad we get to talk to you today. And I signed up and I did go through your KYC, and I'm very familiar with that because I'm an active investor in other areas. So I understand how the know your client works. And it is good that you go through that kind of diligence because I think one of my fears with all this kind of crowdsourced investment, and I see a lot of angel investing and startup investing now, is that people can too easily just invest their money and maybe not fully understand or know the risks or understand where they're going
Yeah.
into it. So you've kind of covered a little bit of the sort of the brief of what Buy Properly is. Now, how much is the minimum investment? Say I've been approved from your KYC. What's my minimum to get in?
2,500.
Okay, and that gets me what fraction of ownership? Are you funding the 100% of the building's purchase or the house purchase, or is it property dependent? How does that work?
Yeah, so it depends. This is the equity offering of the house, right? In typically what we do is we would have mortgage to about like 50%. We don't try to lever it up quite a lot because then it's not cash flow positive.
Right.
You may have vacancy and all of that problem. And we don't want to go back to investors and say, hey, we had to replace the faucet and it costs like $200, so your share is like $2. We don't want that situation to arise. And so that's how it's structured. But when you say in terms of share, of course, if you're thinking over a 5-year period, once you've paid off the debt, then your share of equity is what you're getting. So say if it was a 500K and 250K is the equity portion of it, and you invested 2,500, that's the proportion that you own for it.
So you would own 1% in that case, or would you own 0.5%?
You own 1%.
Of that, okay, so you
So it's
participate in the gain
it's
of the 250, obviously, right? Not the entire property. I mean, it's just math. It's just math at that point. You're
Yeah.
dividing it up, right? So,
Yeah. So
okay, well,
2,500 divided by 250.
let's get back to the basics before we get too deep into it here. Because I know one of the questions that, the Economist and I asked ourselves when we first started reading about all these kind of crowdsourced real estate, which is,
Yeah.
I think democratizing real estate is a really interesting thing because the price is so out of reach,
Yes.
especially we're in Victoria, you're in Toronto, right? That's where your offices are. I mean, we know how expensive real estate
Yeah.
is. So I've invested in residential REITs before, and I still hold them. Why wouldn't people just do that? Why is Buy Properly different, or what are the advantages?
Yeah, so if you think in terms of concept, the REIT and what we are doing is kind of similar. We're taking something big and breaking it down into smaller chunks to let people buy. But I think that's where the similarity ends, sort of, because for one thing, when you're investing in the REIT, you're effectively investing with a fund. So you're investing in this fund, and you're kind of saying that, okay, I've invested, and I'm invested in REIT as well, but my REIT is not making money at all. But I have a Vanguard REIT ETF. And so when I invested in Vanguard. I'm assuming that's a big brand. The fund managers know where they're putting the money. But that's the end of it. When you're investing with BuyProperly, you are saying, okay, I like this house. One of my customers actually drove past all three options that he had and said, okay, I like this one and I didn't like the other two. So this is, you're choosing what you're investing in. You know exactly what you're getting into. So you're not counting on me to say, okay, I promise you, I will invest in the right places. Just give me your money and get the return. Instead, you're saying, this is a house. You can see the house, this is the condition, and this is where your money is going. So it's almost like doing your private deal, except that private deals right now are just not accessible to regular people. And the advantage of doing it that way is, one, the correlation to the stock market is really low. So when you look at REITs, 30 years ago, yes, they were not as correlated to the stock market because they were new to the space. But now, if you're talking about publicly traded, regular, liquid REITs, the correlation to the stock market is as high as 0.7 to 0.9. Like if I take my own Vanguard REIT ETF, it moves exactly in tandem with the rest of the stock market. It is not any different. So when the stock market crashed in Jan, it went down. So last year, Jan, with COVID, stock market went down 30%, the REITs went down like 25%. The housing market, the private deals, however, were up 8%. So then you're not really diversifying when you're doing REITs. That's another big difference. And if you're talking in terms of returns, if you're going to a REIT, think about it. My Vanguard ETF has 5 REITs under it.
Yep.
Then each of those REITs have fund of funds. And each of those funds have some private equity funds under them. Then they invest in developer/marketer, who then invests in the actual developer who's actually doing something with the property. So if everybody would have taken a cut, you can imagine whatever the initial asset generated, you are so many layers away that you can only get a diluted version of it.
That's a great segue into fees, because that's sort of what we're talking about. And the layers, I don't disagree with you that when you get into these big REITs where they basically are commercializing or commoditizing, housing or commercial space or industrial space, whatever it is, it's become a commodity, right? So they have their layers of fees, like you said. What is the fee structure for BuyProperly, and how does that work for investors?
Yeah, so our fees is 2.5%. No hidden charges, no additional things, nothing else baked in anywhere else.
Okay.
This is the net cost, which is sometimes very different from any ETF or mutual fund or anything that you buy, because typically the fees would be stated as 0.5%. But then there is commissions and this and that, which is hidden underneath. So when you put in $100, only 95 actually went in.
Yeah. Well, okay. There's my question then. The 2.5 is on the initial investment. So does that come off before you get your equity stake?
So what we do is, because this is a recurring cost, because we are managing the tenants, the property,
Right.
all of the other things, sourcing, exit, everything is being done by us. The 2.5% is an annual fee.
Okay.
Typically what we do is, because these are rented out, we just take it out from the rent and then distribute the rest of the rent as dividends.
Okay.
So most of the times you're not dealing with it in
Okay.
any other manner.
So you charge that 2.5% quarterly then, is that right?
Annual, that's the annual fees.
It's the annual fee, but you break it up into quarterly installments?
Yes.
So there's nothing due when you invest your 2,500.
Correct. And there's nothing due when you exit, because we don't charge anything when you exit. So the exit gains are entirely yours. And that 2.5% is based on your initial price. So if you invested like 10K and that 10K worth of property is now worth 15K, we're still charging on that 10K. And so even if the market price has gone up, you're still doing that, unlike, say, a mutual fund where you have a net asset value adjusted. So you're constantly paying higher and higher values.
Yeah.
Or alternatively, I guess if it goes down temporarily, you'd be paying fees on something above the. If it went down to 8, you'd still be paying on 10.
True, true.
Oh, that's interesting.
4
I
or
didn't look at
5
that.
year period, although I would say that that's rare to happen. We actually tried that. We built an Excel with it, and we are thinking maybe we'll put up on the website where you can just pick any 5 years and it will be okay.
Well, have I got something for you, Khushboo?
Okay.
I agree with you that that should be rare to happen. Like
Yeah.
we've seen great growth in real estate in the major centers in Canada. But here's a little anecdote for you. And
Yeah.
The Economist and I were talking about this in preparation for the interview. You're probably familiar with Addy, or what started off as IMBY. It's the Vancouver. It's kind of the crowdsource as well. They haven't quite done the platform the way you're trying to do it. Anyway, being the adventurous investor that I am, we both jumped in at the very beginning. We're like, let's do it. The first property, why not, right?
Okay.
And funnily enough, that was in late 2018 in downtown Vancouver, well, east side Vancouver. And we were looking at it the other day because, of course, we got our 2021 updates that came out. And I've lost money. I've lost money in Vancouver real estate. My original $500 investment is now worth only $440. So I just found it really interesting, and this is it was just anecdotal, because I know we've done a lot of research into private real estate, like actually owning our own real estate and things like that. And the general assumption is that our continued awesome growth in real estate in all the Canadian centers is going to continue, right? And I think especially people in Saskatchewan, our listeners there will chime in and say, no, our market's been pretty flat for a few years. So just anecdotally there that I've experienced how the cost, and I think part of that, and the assessment has gone down, but also the cost of the building and maintenance and things like that. So that kind of brings me to the next question as far as property management, capital expenditures, major repairs, things like that. What kind of contingencies does BuyProperly build into your model so that my equity stake is sort of preserved? What do you think, Economist? Is that a good way to ask that question? You see where I'm trying to get at there?
Yeah, go ahead.
Run with it.
Is a question like, how do I ensure you don't lose money?
No. I mean, let's be fair here. All our listeners are sophisticated investors. We all know there's risk in everything, and we can lose money. And that's not my question at all. I'm just saying I think we can all accept that there's costs to doing business in real estate. You mentioned a little bit earlier, whether it's vacancy, whether it's tenants. Like I know part of the problem with Addy last year is they had a tenant that didn't pay, right, because of unfortunate times in COVID. So, there's things like that. There's CapEx that's going to happen with a property, unforeseen repairs, things like that. So all those kind of expenditures, you build those into your business plan for the property. How does that impact an investor?
Sure. So let me start with that, and then I'll come to the whole Vancouver experience that you guys have had. So
just a story.
Well, it's a true story, so it's worth discussing.
Yeah.
So in terms of expenses, we are super conservative in general. Like when we are stating something, we've probably factored in twice the vacancy that's normal for that area. We've probably factored in property management costs, bunch of insurance costs, etc. We usually, like when we are saying the return expected is 7%, most likely we know that it's way more than 7%. So we're not trying to paint a rosier picture. We'd rather under promise and over deliver.
Yeah.
All of these expenses are real. They happen whether you are owning a property with us or in reality. Some of that is baked in, so we try and keep some amount of reserves upfront. So we are not picking up dilapidated properties. We do tons of inspection, all of that, making sure if it's a condo that the condo has enough reserves. They have what their forecast is for the next 3 years is known in terms of budget. So there's a certain amount of known variables in there that we're not getting into. That said, there can always be a surprise.
Yeah.
That's where one insurance comes in. You talked about tenant. Some vacancies already factored in, but say you had a COVID scenario where you have a tenant who says, hey, I don't think I can pay anymore. Take it or leave it, like reduce my rent to half or zero. Those are the choices. We have a tenant insurance, which means that we basically have a monthly insurance, and if the tenant doesn't pay during the lease period, the insurance company actually covers a cost. They will pay the full rent. Of course, they have to vet the tenant we are bringing in, which means I can't bring in a shady tenant that had no chance of delivering on that.
Yeah.
They do the initial check, but once that the tenant is qualified by them, if the tenant doesn't pay, no matter what the circumstances, including COVID, they would pay if the tenant can't pay. And if the tenant doesn't want to leave at the end of the term, they cover eviction costs and any losses related to it. So we've tried to build in some of these contingencies and pre-planned and being conservative. That said, yes, a Vancouver situation like you had can happen. And to avoid that, basically, I think my team and maybe partly me is like a bunch of nerds. So we've done tons of analyses. And COVID helped because we couldn't rush and do deals because everything was closed and we couldn't do open houses and we couldn't go see property. So we said, you know what, let's do more analyses.
Yep.
So what we've done is we started with like a high level macroeconomic analyses. We've done that for Canada, for US, and a bunch of places in Europe as well, where we intend to expand to. So places not obvious to you, but places like Portugal, in Poland, because you can make way more returns in Gdansk than you can in London.
Yep.
And so we've analyzed some of the top real estate markets, and the intent of that macroeconomic analysis was to say, hey, where are some of these top real estate performing cities or the top cities in their real estate life cycle? So for example, when we analyzed, and this analysis was done in 2019, actually, when we started out, that was the first thing we did. We realized that Vancouver is in the late real estate life cycle. Real estate is also cyclical, like most, it just has a longer cycle. It's more like an 18, 20 years than a 7 years stock market cycle.
Definitely,
and so we try to place them on the real estate life cycle based on things like their vacancy, average vacancy, median vacancy compared to a long-term vacancy, like a 15-year vacancy. So where are they on that? In terms of building permits, how many permits are going out, and what is the net influx of people coming in? What are some of the supply demand statistics? So if you look at Toronto, for example, 2018, 95,000 people net came into GTA, 65,000 net houses went into the market.
Right.
So clearly there's a mismatch, which is why the prices were being driven up more than anything else. And so I think we did a lot of these as well, job permits, job growth, GDP, tons of that, compared it to like a 15-year, 20-year median to say, hey, where is it in these terms? And then picked the cities that we want to play in, the regions we want to play in. That was the first cut we did. Then we actually did the next cut, which was neighborhood level cut. So once you're like, okay, Toronto qualifies, does downtown Toronto qualify? For us, it did not.
Okay.
But did Hamilton qualify? It did.
Okay.
Yes, there are places that wouldn't qualify. So Halifax was like a maybe. A Moncton, for example, is like, yeah, it qualifies, but then there are other challenges. So
right. So you're basically talking about the 1% sort of type benchmark that a lot of real estate investors look at is like, does this market have support for that with its house value versus its rental value? Is that kind of the research you did?
Fundamentals.
Yeah, exactly.
And then we did the unit level analysis, and we built an AI model that helps us kind of identify what's going to underperform, overperform.
Yeah.
Because like, yes, I can hire a bunch of investment bankers to do due diligence on each of those properties. That's just not scalable. So we said, hey, let's automate with AI. And so, yes, so we've done a bunch of analyses to avoid picking up some of these properties, like a lot of the properties that come on the platform. And actually, I was talking to my husband earlier, like most of the properties you bring on your platform, it's like you could buy it for yourself and live in there. Like, yeah, that's kind of,
that's the idea.
If I'm willing to put my money in, only then will I put somebody else's money in.
Yeah, exactly. My experience with Addy was that they provide a letter, what is it? It's an offering memorandum, which gives all the sort of the legal details and everything to do with that and the finances of the property. When I went into BuyProperly and I clicked on sort of, invest or whatever, it basically asked me to transfer funds. Now, at what point do I get to view the detailed financial breakdowns of the property as if it was a real estate deal that I was sourcing myself? Do you provide all of that to the investors before they
Yes.
sort of click?
Yes.
But they have to send the money first before they get that information.
Sort of, yes.
Sort of.
It's like, we need a little bit of commitment from you, but
No, so here's the thing. Our website is also going through some. So you see a section called documents and you see no documents there.
Right.
But all of these appear there.
Okay.
And so we're a startup, so you have to forgive us for that. But there's a section called documents where you would normally see this
Okay.
stuff
Okay.
already before you click on that. It's just not gone live with it yet.
I have to say, I'm not going to lie, because this was the thing that gave me pause. Is like, they're asking me to send them money already, and I haven't gotten to do my due diligence yet. So I just wanted to clarify that, so that any listeners that are potential investors, that's not, if I send you my $2,500 and then I get the paperwork and I go, you know what, there's something about that doesn't work for me. Obviously I can request that money back because it hasn't gone into a deal at that point, or maybe I leave it there for a future deal. Is that an option for investors?
So usually you will get all of these documents in the document section.
Okay.
I think we are updating the page right now. I can't see it, which is why I'm also surprised, but we are updating that page right now. But in the document section, you should be able to see all of the math, including what was the closing cost, what was the legal fees, like entire detailed structure of the cost, any pending expenses. So for example, when we are doing a condo, we will talk about reserves, etc. All of that appears in the document section. So you can actually read through that before you have clicked on buy, because the assumption is that if you're clicking on buy, you've actually read that.
Yes, fair enough. Exactly. That's what I was thinking when I clicked the invest button. I'm like, there's things I haven't read yet. Okay, well, that's good to know. I'm glad that actually clarified a big question for me.
And the challenge the reason we were revamping the page is because we had just put in like a detailed document in there and nobody would read it.
Totally.
Absolutely nobody read it. And so now we are trying to convert those long form documents into, say, can we show it in the form of a graph or something interactive so that people can actually understand what's going on? Because we were getting questions like, what's the difference between an IRR and an ROI? Because the other company keeps telling me I'll get this much ROI, but what's the ROI? And this is the 7% all I will get over 5 years? I thought it's growing at 7%, but it's annualized. So things like that were a little difficult in those long form documents. So we're trying to work with our legal to say how we can represent all of this so that it's legally and technically accurate, but also simple to understand. So you will see all documents.
Yeah, that's a great answer, because I think that's a really big part of it. And I think it's interesting what you said there, because the idea of democratizing this real estate investment for everybody so that you make it, like you alluded to at the beginning, it's super easy. You go online, you can pick the house, decide if that location, if that particular house, if it's something that you personally want to invest in. One of the difficult parts, as you mentioned, is you're going to have uneducated investors that just go, of course I want to be in Hamilton real estate, and they throw $2,500 in there. And you're right. 95% of the time, I'm just picking a number here, they're not going to read all those legal documents and dig deep enough into it. And that's okay. That's just accepted risk on that part. I think it's incumbent on BuyProperly or whoever is providing that, is to try and provide all the information, of course, but like you said, is trying to create at least something that they're going to read the basics of. I see where it's that tough little spot of having a kind of a novice investor. You want them to understand, but if you inundate them with too much information, they're just going to be confused and not know where to go. That's a real challenge for sure.
And even for me, when I was reading the ADDI memorandum or offering memorandum, I was only looking for select things, but I had to go through
it's pages and pages,
200 pages of documents to find the highlights, right? So to have them all in one place would be good.
Yeah, definitely.
Like even with the offering memorandum, when we shared the offering memorandum with our customers, I had the legal team do a version, and then I did a version where it doesn't matter if legally this explains these problems. It is not obvious. And so I was like, we have to say it in simple terms that, and even if it at the risk of repetition, I have to explain it in simple terms what it really means, even if I've already said it in a complicated manner, and this covers all of the things.
Yeah.
Because it's not just about protecting me legally, it is important, which is the job of my lawyers. It's
Yeah.
also important that my customers understand what I'm talking about. Like, even we have talked about things like the risk of us going under as a startup.
Right.
What happens if we go under, and how is your property and your investment protected, and no correlation to what happens to us,
Yep.
because it's a separate entity? And what is the protection mechanism? What will you do if that happens, and things like that? And not in a legal language, but in a legal language plus a simple language. And we have simple math examples to say, this is what it means for you. For example, if you put in 10K, this is what will happen, and this is what will happen.
Yeah.
Kind of a thing. So
Yep.
we've tried to simplify as much as we can.
Challenge for sure.
Just going back to the website, I see you have some sold out properties and then some live properties, but you've also got one that says accepting resale investments.
Yes.
What does that mean?
Yeah, so we have a secondary marketplace that we are just about opening. And this is the only one that we are doing the pilot with. So it basically means that if there was an investor in Oakville and there's a default lock-in of 5 years, and say they want to sell in 1 year time or 2 year time, for whatever personal reasons, they want to exit the investment, this is their mechanism for exiting. So they can list it on the platform and sell to anybody else who wants to buy. So this is one of those properties.
This is one of our questions that we wanted to dig into, because that's a really challenging area in Canada from a legal standpoint, is to create a secondary market for exempt securities, exempt market securities.
Yeah.
So you've managed to do that. Is it specific to Ontario? Is it, if I'm a British Columbia investor, will I be able to participate in the secondary market? What is that secondary? What do you envision it to look like? For me, I envision it to sort of be able to go on and put up my shares of my house in Hamilton through BuyProperly, and then my buddy Steve in Edmonton can go on there and go, oh, I'd like to buy those 10 shares of that house, and just real simple direct online exchanges. How do you see it happening?
That's how I see it happening.
Is it going to happen like that with our regulations in Canada?
Technically, it can. Practically, it's a bunch of hoops I need to jump through before that can happen. And this was a small pilot to say, are people even interested in something like that? That's the first question.
Yeah.
Like, how many people would want to sell? Or like in Oakville, I'm the only one who wants to sell. So I have a tiny stake so that I can pilot. But nobody else wants to sell right now because they've held it only for 1 year.
Yeah,
right.
They want to sell.
Yeah.
Like, why would they want to sell so quickly? They got in because the real estate will grow over time. But then this was to run. So technically it is possible. Yeah. And our vision is to make that happen. I think given that me and my CTO were both at Amazon, that's how we see it. We've seen sellers being able to list their product for sale. We're trying to replicate that ease of both selling and buying.
Yeah.
That said, it's a huge, humongous task even for Amazon to make that and facilitate that. So for us, within the security space, it's going to be twice as difficult to make it happen. But the first thing that we want to do and ensure is on the platform, it can happen in a secure, safe, correct manner.
For sure. Yep.
And then there's the regulatory angle, which we are working on in parallel.
Yeah. Because a big part of any kind of crowdfunding is scale too. So, you get to 100 properties in Canada and you've got thousands of investors and you've created a secondary marketplace. It's like you could be dealing with potentially a lot of transactions happening. It's an interesting, having your background experience with Amazon probably doesn't look as daunting as it does to me, going, wow, I can picture the secondary marketplace, but the actual mechanics of it are overwhelming when it comes to property, just because there's a lot more detailed in the buying and selling.
Yeah, and both Peter, my CTO, and I, we launched a hazardous materials marketplace at Amazon,
Okay.
and that had tons of compliance and legal.
Oh, yeah.
And the risk that we were always told was like, hey, if you get this wrong and the wrong product ends up in like the wrong building, the building can blow up. So we were like, okay, here the worst case is somebody loses money, but at least nobody's going to blow up. So it's safer than that. So hopefully we will figure out a mechanism to make it work if we made that one work.
Right. Do you plan to charge a fee for someone to sell on the secondary market? It seems like it would be reasonable to.
We would, but nominal. We'll want to try and cover our core costs for that, but that in our mind is not a money-making mechanism. We would rather want people to be able to sell and buy as they want, especially on the sell side. If somebody is rushing to sell, clearly there's a personal circumstance, and I wouldn't want to take advantage of that. So I would rather they do that more freely.
Oh, one more thing,
Yeah.
kind of in the same line. What happens after the 5-year lock-in period?
Yeah, so 5-year lock-in period is the default exit point or liquidity event, if I may say. So the intent is that we either sell the property in the open market and everybody gets their returns and capital gains, etc., is passed on, or we retain and recycle investors. So there will be some good properties that we may not sell to the external market, but retain as BuyProperly just because it's a well-performing asset. But the existing investors still get that option to exit at that 5-year point.
But don't have to.
They don't have to. Yeah.
Interesting.
I'm just going to time out here because our Zoom link is going to time out.